Good morning. Welcome to Morning at 10 TV. My name is Malaki Vilaudera, and the solutions segment today will be focusing on you, the SME. We were having Andrew Chamagero on the ground speaking to, a lady in the confectionery business, and she was saying that it is hard for her to access financing from banks because the interest rates are up there. It's so hard to sustain that particular loan. And so it's the same conversation many business people are having, especially small and medium scale, enterprises. And so today we'll be having that discussion to cap or not to cap interest rates, especially when it comes to banking institutions. And so we had the finance minister, the state finance minister, Mr. David Bahati, a few days ago coming out to, send out a strong message to commercial banks actually for them to look into lowering the interest rates. But before I say a lot about what he said, let's hear it from the horse's mouth.
We recognize that you have risks you have to take care of, but also we continue to be concerned about the interest rates that you charge your customers. Because at the central bank, we have continued to lower the prime lending rate, but we don't see a response from the commercial banks. When I was a backbencher in Parliament, before I was given an opportunity to serve on executive, I had started drafting a bill to cap the interest rate, the way the Kenyan side has gone. But when I was appointed as minister, I abandoned that idea. But it appears you want to force government to do that. So we want to recognize that the interest rates are still high, and want to encourage you to continue bringing them down so that your esteemed clients can borrow money, invest, and make profits.
So that was his announcement, pretty much like a threat to commercial banks. But in studios to talk about that, just for us to understand what will happen if the government moves to cap the interest rates. What are the pros and cons of capping the interest rates? And in studios joining me is Grace Makoko. Thank you so much for joining us. She is a career banker, so the right person to speak to this morning. Thank you so much for joining us.
Thank you,
so we had the state finance minister, Mr. David Bahati, coming out to say that the government has tried to speak to commercial banks to reduce the interest rates so that SMEs can access this money, expand their businesses and make profit, and in turn boost the economy, but the banks are not listening. You are a banker. Tell us more. What's happening?
Well, I think a number of things go into how banks decide what interest they charge. And I think this is a dialogue or a discussion that has gone on over the years in Uganda, but also in the region in East Africa, with government and maybe also the general public wondering, why do banks charge very high interest rate? And I think it's one of the things is to understand what really goes into how banks compute the interest that they charge.
Yes.
So I'll just touch on 5 things. So it's cost of capital, as you raise capital to do the banking business. Cost of liquidity, because banks don't have money. They take money from depositors and then lend it to creditors. So there's cost of liquidity, just raising that liquidity and being able to be out there. And there's cost of doing business. If you have a branch network, think about things like utility. A lot of the banks run on generator. If you have branches up country or branches even within the cities, they run on generator. There's all sorts of costs that go into doing business, so cost of operations. Then you have the credit risk, because you have to rate these clients and charge for the risk. And there's all this whole regulation. There's part of cost of doing business, but also related to credit risk is the regulation. You have think about the recent regulations like the IFRS 9 that says you should price for risk and you should be able to put aside money before you even lend, to have a measure of expected loss. So all that, those are costs. Then you have your net profit margin. So quite a bit goes into the decision on what interest to charge. It's not just a figure you work out.
But
So once you put in all those costs and given the risk profile of the clients that you have in the market, you're going to have interest rates where they are.
But also banks actually operate on volumes. So the higher the number of, accounts they have, the easier it is to run the ops and stuff like that. But we also know that the interest rates have been skyrocketing day after the other. Even if the prime lending rate from the central bank is actually, pretty much on a lower side, so to speak, compared to what the banks, charge their clients for. So why are we having that disparity? Banks are accessing loans from the central bank at, pretty much, prime loans at a pretty much, comfortable rate. But after now they come to charge their clients, it's skyrocketing. What goes into that? Why are we having that big disparity?
Not all the money, actually the banks are expected to lend customer deposits. You would go for financing from the central bank on short-term basis or in the interbank. You don't necessarily take long-term loans from the central bank. Just the business model is such that you take deposits and then you lend them. But like I said, there are all sorts of nuances when it comes to how you decide your costs. If you look at 2016 as a case in point, where banks had the industry had very high NPLs, the non-performing loans. Once a loan is non-performing, you, Mala, if you put your money in the bank as a depositor, we're not going to tell you, oh, we lent it to, so and so, and they haven't paid back. We're going to have to find and give you back your money. Now, if you look at things like the procedures, the foreclosure procedures, look at things like in the land registry, just getting collateral registered, when someone becomes collateral and getting it registered, the costs involved. But just the foreclosure procedures, the court system, all that involves money. So getting to foreclose on somebody and then actually realizing, selling off their security to get the money, to get back the depositor's money, to get the money you loaned them, all those are costs. So banks will factor that in and say, okay, so I've lent so and so, I've lent so and so and Sons garage or SME so much, and in the event that they fail to pay, how quickly will I be able to realize the collateral? Some people don't really have good collateral. So you even have to say, okay, what's the risk? If I lend so much, what's the risk when I finally foreclose?
So pretty much the interest rates are very high just for the banks to cover their risks.
There's a big chunk of that is covering risk, but also cost of raising capital, cost of liquidity, cost of operation, cost of doing business.
Over and above that, you're still seeing banks making quite a lot of money. By law, they are demanded to actually, publish their returns every single year?
Yes.
Every single financial, annually, every single financial year. And you're still seeing banks, having the highest rates of return on equity. That meaning they're making actually doubles every single year on, year out. They're making so many profits. So, and we're saying that it's okay for the government, actually the risk, the threat that was made, and we're saying that the government is rightfully so, at a good place to just threaten the banks to bring down the interest rates. They're already making so much profit.
Banking is profitable, but risk and return. It's just a risk and return formula. High risk, high return. So you find that in the years where we have the economic situation is good, everything is going well, the banks will do well. But no one remembers when the banks are struggling. And we saw that in 2016 with the non-performing loans. We saw that when we had a number of bank closures. So you actually, you make hay while it shines, but there will be a time for rainy season, and that can wipe out what the public, what is appearing as success for 4 straight years can get wiped out in the 5th year and the 6th year.
So banks are just being strategic just to prepare for the dry season.
It's just taking risk and making sure that you have priced for that risk and then getting a reward for taking risk, because that's just how business works. You take a risk and you get rewarded for it. Sometimes you get burnt. When we also saw what happened to our economy when South Sudan went up in flames. A lot of banks suffered non-performing loans. So it's a risk and reward. Just think about it as risk as well. Not so much that the banks are always making money, but it's a profitable business, but you have to price correctly for it. And banks, if you look at the top 100 taxpayers every year, banks are the top taxpayers in the years that they make high profits. So it's not like government is not benefiting. They are benefiting because banks pay tax. Banks, if you look at the number of people employed by banks and the jobs created by banks being able to give credit, banks are playing a huge part in driving the economic growth.
They surely are, but still it's a conversation. But let's get to the pros and cons of capping interest rates, especially bank interest rates on loans. What are the disadvantages? We saw Kenya move to actually cap the bank interest rates for the commercial banks. And so right now they're having a conversation on how to reverse that. They're saying there's a ceiling, there's, you know, the bottom line, and so it's hard, it's getting to a hard point. Fine. When they were starting, they were saying that capping the interest rates, like we're seeing here, will ensure that, you know, SMEs access this financing at a cheaper rate. But still, after the capping, now we saw commercial bank put stringent laws for you to access, you know, just a basic, you know, kind of loan. So it was even hard for people to qualify for these particular loans. So just get us into that perspective. Let's start with the pros of capping interest rates before we go to the cons. Okay.
So I think it's just the context of where government or parliament in Kenya were coming from, and probably now what Uganda is thinking. And it's what I would say is unintended consequences. But like you said, the intention was saying, okay, the burden of on borrowers for repayment is high because interests are high. Let's try and see how we reduce that burden by reducing the interest rates. You reduce them by capping. In Kenya's case, they said it will be the central bank rate plus 400 basis points, but 4%.
Actually,
that
it's
would
now
be the
14.5%.
Yeah, so that would have been the cap. And they said, okay, so if we said that everyone borrows at the central bank rate plus a certain percentage, or 4% in that case, or 4.5, then you will have people being able to repay. Secondly was financial inclusion. You touched on it and said that more people would have access to credit, particularly SMEs. SMEs are more than 90% of businesses.
Right.
Yeah, and they create all new jobs. About 30% of all new jobs are coming from SMEs.
Yes.
So you're saying these are the drivers of GDP. You're saying, so let us see how we can be more inclusive, how we can get more people to get access to credit. So that's the thinking, and that's the thinking on paper. That if we cap interest rates,
on paper.
Yeah, if we cap interest rates, then we shall reduce the burden of the borrower repayment, but also financial inclusion. We shall get more people to access
and boost
credit.
the economy.
Now, that sounds all well until you see, like I said, because when you go down to the nuances of what makes a bank want to lend somebody, what are they looking at? So we found, and Kenya is a good case, what happened with Kenya is already before the interest rate cap, corporate loans are the biggest percentage of all bank loans. Right. But by the capping of the rates, banks now looked at their credit, how they do the credit rating, looked at how they weigh risk, how their decisions to lend, and said, okay, if I'm only lending at so much, I need to lend to a high quality or high caliber clientele. Yes. And that tends to be the corporates. They are, you know, they in terms of survival, how long they survive in business, they have processes and procedures in place, they have good best governance practices. Yes.
They can afford the collateral. Yes.
Yeah, so better bookkeeping, better record keeping. A lot of them have a track record already. When you're a corporate client, you probably have a track record of performance. So those are people who the banks went after.
Low risk clientele.
The low risk clientele. Now that aggravated the imbalance. Already you had the bank loan books with the majority going to corporates. Now you had that even, the imbalance getting bigger. So the SME was not going to get access to this credit because of the stringent risk profiling. So that was just the, so you found that it squeezed out the SMEs. So what should have brought in, first should have had financial inclusion, increasing financial inclusion, you actually ended up edging out the SMEs. Then you had the attendant job losses. Even with banks downsize their teams, because if you're going to lend to corporates, you don't need a huge collection team. you don't need, some of your staff members are made redundant, the ones that would serve the other segments. So you had job losses within the banks, but also job losses with the SMEs, because if you can't get credit, you can't pay your workers, so you're going to downsize. Then you had a loss of revenue to government because banks reported less revenue. So from taxes, government collected less. So unintended consequences. So what was supposed to have on paper brought positive results actually became a negative.
Right, right. And actually now they're thinking of, you know, relooking that and actually bringing it back down. But let's have this conversation about, you know, once Uganda takes that route and just decides, the government of Uganda decides to cap the bank interest loans. What then happens? What next? Help us understand. If, for example, you today had, you know, a loan with X bank, and the government moves to decide to cap the interest rates. Now, if you had, be it a fixed cost rate or be it a variable cost rate, will now the capping, the new capping rate, affect the deal, the agreement that you had with the bank? Or, for example, if you have a current rate that goes for, let's say, 27% per annum, and now after the government comes in to cap the interest rates, brings down the interest rate to maybe, let's get a figure, 16%. Does it mean that now your current loan will get down to 16%? What happens in that event?
What usually, I mean, what would happen is it's the new loans that, in terms of people access to credit, for new loans, the new borrowers would be the ones affected. Existing borrowers, because your government will have come in, so the terms will change based on what government. So it all depends on what the regulation says. The regulation typically will say for new loans, existing loans will stay where they are. Or government can come and say even existing loans should be renegotiated. Especially the people who would benefit from that would be the ones who have a variable interest rate, which changes. So that would change. The ones with a fixed one would probably be disadvantaged.
So in essence,
so it depends on what the regulation would say, what exactly government would say. So it would, but typically how it works is that it would be new loans that would be affected, and say going forward you lend at this. Existing loans, government can say these should be repriced, or the central bank can say it should be repriced within 18 months to reflect the new structure.
Okay.
Yeah.
All
so
right.
depending on how the loan, the terms and conditions of your loan. That's
so in essence, if we have a viewer right now who is, you know, considering taking a loan, between a fixed rate loan and a, you know, variable rate loan, which one would you advise as a banker? What's the best option?
It really depends on your circumstances and the duration of the loan. There are many things that go within that. Typically, fixed rates would have certain conditions before a type of loan. To attract a fixed rate, usually it would be maybe a type of mortgage. It would also depend on the risk profile of the client. Most loans in our markets tend to be variable interest rates. Yeah. So it really depends on your situation. You don't see that many banks offering fixed interest rates. You see it on some mortgages if they given the length of the loan, 20 years, 15 years. Some people will give a fixed rate because you're in for a long time. But the shorter term personal loans, those tend to be at a variable interest rate. And
you'd advise for the variable interest rate? If it's a short-term one, and maybe it's an SME who just wants to borrow to expand or to get more, you know, goods for the shop and stuff like that?
It depends on what interest rates are doing. Okay. So if you feel that interest rates are going to come down, you take a variable.
Do you go a step further and advise the clientele before they make a decision? Does that happen?
Within the consumer protection guidelines, we're expected to speak to the clients and give them guidance and sort of articulate clearly the implications of the loan they're taking. That if you take a fixed loan, these are the implications. If you take a variable loan, these are the implications. So within the consumer protection guideline, we're expected to speak to our clients.
Does it happen? Because there are other terms and conditions that the banks always, you know, remain silent about. And once you're in the loan, that's when you realize, man, it wasn't this easy.
I think as we have more client awareness on what they are, and that's one of the things that is being pushed by a lot of different supranationals like World Bank or IMF, saying that one of the ways, instead of going the route of capping interest rates, there are some interventions you can make. or like foreclosure procedures. If government made the courts more efficient so that cases are heard quicker, the land registry so that everything is in place, you know, collateral registries so that they are mobile or they are, you know, they are digital, digitizing. The third one is customer awareness,
right,
or consumer protection, just debt counseling, where you actually cancel the borrower and say, this is how this and this work. People to know their rights, people to know, just having working knowledge of, if I take this loan, these are the consequences. So that's one of the things that are being put. Instead of capping interest rates, let's just get the borrowers to be more aware. But if I take a loan for this long, if I take a personal loan, these are the implications. And I have also a mortgage. How much debt should I have? You know, the ratio of your income to the debt you take. That will help clients demand more from the banks, and therefore so give that, with that awareness, banks it would drive the behavior of how banks price and how customers are treated.
So that's the option, but not to cap the interest rates.
Capping interest rates is the unintended consequence, and Kenya is a case in point. So Uganda doesn't have to look far. We don't have to go and say, let's look at what happened in Malaysia, or let's look at what happened in the UK. Just our neighbor here, Kenya. Let's see what happened to them. And it's unintended consequences. So you mean well as government, you mean well as parliament.
But in return.
But in the process, you actually are going to hurt the SME, because at the end of the day, the banks are going to look at the action and say, okay, if I can only make so much money, if I can only lend at this rate, I will have to be picky about the kind of person I lend. And the profile of a person I lend will lean towards the corporate side and squeeze out the SME. Where the SME is over 90% of business are SMEs, and they actually drive growth and they create jobs.
Thank you so much. Thank you so much for coming in studios. At least now we have a clear understanding on the pros and cons of capping bank interest rates. Thank you so much for being part of this discussion. Keep your comments coming. Your views are so important, and we'll be sure to float them to her, and maybe she can respond during the course of the day. My name is Malaki Villa-Odera. That has been it for Morning at 10 TV. Be sure to tune in tomorrow, same time, 6:30 to 9 a.m. Have a blessed day.